The Federal Reserve Bank has started their pivot on interest rates, and this comes after early December where Jerome Powell, who is the chairman of the Federal Reserve Bank, kept saying that the Federal Reserve Bank is not thinking about cutting interest rates. In fact, they're thinking about potentially raising interest rates more. Well, in the Federal Reserve Bank's most recent meeting, they have come out and said, prepare for interest rate cuts in 2024. So what I want to do in this video is break down what these potential interest rate cuts mean for the economy, what they mean for asset prices, and of course, what it means for your money. So let's jump in by starting about number one. What is the Federal Reserve Bank saying right now? There are 4 key points that you need to understand from the Federal Reserve Bank's last meeting. Number 1 is that inflation is coming down. Number 2 is that unemployment is rising. Number 3 is that the Federal Reserve Bank does not want to keep interest rates too high for too long. And number 4 is that the Federal Reserve Bank is penciling in 3 interest rate cuts for 2024. Let's start by looking at inflation. The most recent inflation report that we got in December says that inflation, CPI, came in at 3.1%. But that's not the data that the Federal Reserve Bank likes to look at. The Federal Reserve Bank likes to look at an inflation number called core inflation. And if you take a look at this chart, what you'll see is that core inflation is now down to 4%. So you have core inflation at 4%. This is what the Federal Reserve Bank likes to look at. CPI inflation at 3.1%. But the Federal Reserve Bank is aiming for a 2% inflation target. So we still have high inflation relative to what the Federal Reserve Bank wants. But what they're saying is that because inflation is falling, this is good news, and this can give them ammunition to start cutting interest rates in the future. But what I want you to remember is that inflation is compounding. The lower inflation numbers that we're seeing today does not mean that prices of things are falling. What it means is that the prices of things are rising less fast compared to last year and the year before. But you have to remember, inflation compounds each and every year. That means the inflation that we saw in 2021 was very high. And then the inflation that we saw in 2022 built on top of 2021's inflation. And then the inflation that we saw in 2023 built on top of the 2022 inflation. This is why you're seeing such a big gap between people's incomes and the cost of living. It's because over the last few years, the cost of living has been growing significantly faster than people's incomes. And now when you compound that year after year after year, it becomes much more difficult for people to be able to afford things. And that's why we've been seeing this bigger gap between the rich and the poor. It's because of inflation. So now that we understand what's going on with inflation, we've been seeing inflation cool. It does not mean the prices of things are falling. It means that the prices of things are rising less fast. Let's talk about number 2, which is unemployment, because the Federal Reserve Bank has come out and said that unemployment is expected to rise to 4.1% in 2024, and this is good news because that means they'll have more ammunition to start cutting interest rates. Now, let me explain what this means, because this was a really interesting topic. Because the Federal Reserve Bank has been saying for a long time now, since 2022, that the labor market is too tight. Too many people have jobs. Too many people are seeing wage growth, and because of that, it's creating more demand for goods in the economy. What does that mean? It means everybody has an income, everybody's seeing incomes rise, and because everybody's seeing more and more money hit their bank accounts, everybody has money to go out and spend at Gucci. And because everybody has money to spend at the store, that's creating all this demand for items, and that's forcing the prices of things to rise. And so in order to cool down inflation, one of the impacts that the Federal Reserve Bank wants to see is a slowdown in job growth, a slowdown in wage growth, and an uptick in unemployment. That's why now when the Federal Reserve Bank says that unemployment is expected to rise to 4.1% in 2024, that's good news according to the Federal Reserve Bank, because less people who have jobs, less people with job growth means less demand to buy things in the economy because less people will have an income. So when you talk about what's going on in the labor market, understand what the Federal Reserve Bank wants isn't always what regular people want. This brings me to the third point that the Federal Reserve Bank made, which is that they don't want to keep interest rates too high for too long. Now, I do want to let you know here that if you are interested in learning more about how you can take control of your finances and create your own income streams, we have a free ebook at Briefs Media on how to build wealth as an investor. This ebook will walk you through how you can start using your money as a tool, how you can use your money to generate cash flow, how you can use your money to buy the right assets and build wealth for yourself. So if you want to get a copy of this ebook, it's completely free. And I got the link to how you can download this ebook down in the description below. The Federal Reserve Bank raised interest rates at some of the fastest rates we have seen between 2022 and 2023. And the impact of higher interest rates are, well, it slows down the economy, it slows down spending, it can hurt asset prices. And this is where the Federal Reserve Bank is saying, we don't want to keep interest rates too high for too long. Why are they saying that? Because, well, the Federal Reserve Bank doesn't want to see this pain in the economy. Because the Federal Reserve Bank is walking this tightrope, where on one hand, they want to cool down inflation, but on the other hand, they don't want to cause a massive depression. And the way that they kind of navigate the economy and inflation is through interest rates. Because when you raise interest rates, it slows down spending. It slows down money entering the economy because borrowing slows down. So when you slow down spending, that cools down inflation. But naturally, that has a side effect because a slowdown in spending means less people are shopping at Gucci. It means less people are shopping on Amazon. It means less people are buying homes. It means less people are spending money, which means these businesses are making less money, which means businesses have less money to pay employees, which means businesses might have to downsize their companies, which means asset prices might be falling. And so now this is where the Federal Reserve Bank wants to balance this. What they're hoping for is that they can raise interest rates to a point where they can cool down inflation and not cause a recession or a depression in the economy. And this is why they're saying they don't want to keep interest rates too high for too long because they risk this pain in the economy. However, the question is, can they keep interest rates at a point where inflation will continue to fall? And that's where only time will tell because 2024 is also an election year, and naturally, there's pressure on the Federal Reserve Bank to keep the economy strong and keep the economy booming because, well, if you are a president, and it does not matter if you're Democrat or Republican, it works the same way. If the economy is strong at the time of your reelection, that gives you a little bit more likelihood of being reelected. But if the economy is crashing at the time of your reelection, people want change. That's just kind of how it works. So naturally, there's pressure on the Federal Reserve Bank to want to keep the economy growing and booming during an election year. And this is part of the reason why the Federal Reserve Bank is coming out and saying that they are penciling in 3 interest rate cuts in 2024. Now, before you take what the Federal Reserve Bank says as gold, let's go back a little bit and talk about some of the things that the Federal Reserve Bank has said in the past, that way you can understand how sometimes the Federal Reserve Bank can be wrong. If we go back to 2021, the Federal Reserve Bank was saying that inflation is transitory and it's nothing that you need to worry about. Then comes 2022, the Federal Reserve Bank says inflation is not transitory and that they are expecting 7 interest rate hikes to get inflation under control. But then by the time 2023 came, turns out we needed 11 interest rate hikes, not 7, in order to get inflation under control. And now this is where the Federal Reserve Bank is saying that we will need to cut interest rates 3 times in 2024. So while they can make predictions, while they have a lot of data, they can't predict what's going to happen tomorrow, and that's why you don't want to take the Federal Reserve Bank's word as gold. You don't want to blindly trust the Federal Reserve Bank, just like how you don't want to blindly trust a random guy on YouTube. But this is where it's important for you to understand how the Federal Reserve Bank's decisions affect the economy, how they affect asset prices, and how they can affect your money. So now that we've kind of laid this foundation, let's talk about how interest rate cuts could affect the economy and asset prices, and your money. Now, to really dissect and understand the impacts of Federal Reserve Bank rate cuts, there are 4 things that I want you to understand. Number 1 is how this would affect your savings. Number 2 is how this would affect corporate debt. Number 3 is how this would affect asset prices. And number 4 is how this would affect spending. So let me start by talking about savings, because in 2023, for the first time, people were able to get decent returns on their savings, especially if you moved your money to a high-interest savings account. Because as of today, at the time I'm recording this video, there are high-interest savings accounts in America that are FDIC insured by real banks that are paying 4 to 5% a year in interest on your savings. These are not certificates of deposits. These are not CDs. That means these are regular savings accounts. You can pull your money out at any time. You don't have to keep your money locked there, and they're FDIC insured. So you have the ability to earn some interest on your savings, and if you compare this interest on your savings to what the reported inflation is, not what the inflation is that many people feel, because many times, in fact, most of the time, the real inflation rate for people is about double the reported inflation rate, but let's ignore that for now. The interest rate that you can get on these high interest savings accounts are higher than what people are seeing in the reported inflation numbers. That's good news. If the Federal Reserve Bank starts cutting interest rates, well, that would make your savings less powerful because then your savings would be growing less quickly because then banks would also cut the interest rates on your high interest savings accounts. Second, when it comes to debt, this one is probably the most pressing and has some of the biggest impacts on the economy because there's a lot of issues in the debt market right now because we are seeing more debt than ever. We're seeing a record amount of national debt held by the government. We're seeing a record amount of corporate debt held by businesses and commercial landlords. And we're seeing a record amount of household debt held by regular people. Now, the reason why interest rates matter so much is because most of this debt is not 30-year fixed rate mortgages. In fact, most of this debt is a variable interest rate. For example, this national debt that we have held by the government, a lot of this debt readjusts every year, every 2 years, and every 5 years. So now, as interest rates have gone up so significantly, the cost of servicing this debt, meaning the payments that the United States government has to make, have shot up significantly. Not just because they have more debt, but because the interest rate on this debt has gone up so much. And how does the government get the money to pay for this debt? Taxes. Through taxpayers, people like you, people like me. But it's not just the government, because the government has the benefit of being able to print money and raise taxes. Corporations are also seeing a similar problem, because corporations many times do not have 30-year fixed-rate mortgages. They have 5-year terms on their debt. That means we are seeing a huge amount of corporate debt readjusting in 2024 and even more in 2025. And this is where corporations are sitting on the edge of their seat, hoping and praying that the Federal Reserve Bank is going to be aggressive with their rate cuts, because if they're not, that means the costs and the expenses for these corporations are going to skyrocket. Not just because they have to pay more labor costs or more rent costs, but because the cost of servicing their trillions of dollars of debt are going to balloon. Why? Because the cost on the interest rate has gone up so significantly than the lows during 2020 and 2021. And then when it comes to consumers, well, a lot of consumer debt, if you look at things like mortgages, is a fixed rate mortgage. So if you've locked in a 3% mortgage, then you really don't have to worry about what's going on with interest rates. However, for people who have things like credit card debt, which is a variable interest rate mortgage, lower interest rates mean that the cost of your credit card debt becomes a little bit cheaper. The third thing that interest rates affect are asset prices. Now, the interesting thing about this is we haven't really seen the impact of higher interest rates on asset prices yet. If you go back to what we were seeing in 2020, 2021, and into the early parts of 2022, when interest rates were very low, stock prices skyrocketed, housing prices skyrocketed. Why? Because if you were a stock market investor, or if you're an institution or a hedge fund, you could borrow tons of money at very low interest rates. And so now if you can borrow millions of dollars at a 3% interest rate, you could dump this money into the stock market, and you only need a 4 or 5% return to make that a profitable investment. So when you have lower interest rates, more money can flow into assets, which can push asset prices higher. We saw the same thing in the housing market. When mortgage rates were at 2.5% and 3.5%, everyone wanted to buy a home. And when you had all this demand to buy a home, what happened? People were buying homes like crazy. Home prices shot up. So those lower mortgage rates then caused asset prices to rise. Now, when we saw interest rates rise, we did see a slowdown of buying in the housing market. However, we didn't see home prices fall. We didn't see stock prices fall. And part of the reason for that is because asset prices generally will need a little bit more fuel in order to fall. And what I mean by that is, let's assume that you own a home. You own a $400,000 home and you list it for sale. If somebody offers you $425,000 to purchase it, you're going to say, sure, I'm more than happy to sell you this home for a premium. But if somebody offers you $380,000 for your home listed for $400,000, you're going to say, you know what? Let's leave this home on the market for a little bit longer because I think we can get better offers on the table. So we didn't see that drop in housing prices. That would take more time with interest rates because the affordability of homes has changed significantly. Naturally, the way that things work is as interest rates go up, asset prices generally go down. I'll give you another example to explain what I mean. If you are a real estate investor and you want to go out and buy a property that's paying a 5% return, you buy this $1 million property, it's paying you $50,000 a year in profit. If you can get a 2% mortgage, that's a great deal. But if you have to get an 8% mortgage, now you're paying more money in interest than you're getting in your returns. It's very hard to make a profit when the interest rate that you have to pay is higher than the return that you're getting from the property. And that's what we're seeing today. We're seeing investment properties where the return is lower than what you have to pay in interest. However, this has been kind of balanced out because, number one, asset owners, the commercial property owners, are saying, I don't want to sell my property for a discount. And then you have a lot of investors that are sitting on tons of cash that are still buying the property through alternative sources of funding. So not through debt, but through other sources of funding to make the deal make sense. And so because of that, we haven't really seen a drop in asset prices. However, if we start to see interest rates fall in 2024, that could create more money entering the economy, which could create more boosts to asset prices. Now, again, this is all in theory. You could also see the opposite happen. And the opposite could happen in the sense that people have already priced in interest rate cuts. People have already priced in the fact that there's going to be more money coming in. And if we don't see that boom that a lot of people are expecting, that could create a less than what was expected emotion. And that could mean that people are already pricing in the interest rate cuts now. And then if they don't see what they're expecting in 2024, that could cause asset prices to fall. So you got to understand there's a little bit of emotion involved in here as well. But the impacts of lower interest rates mean people have access to more money, which can also lead to number 4, a change in spending, because our economic system runs on spending. And one of the factors that influences spending is how accessible is money, how cheap is money. And if money is cheaper, people will be more likely to go out and borrow money and spend. Now, you got to understand, there is a cost to borrowing too much money. I mean, we have households in America that are up to their eyeballs in debt already. And when debt gets more expensive, that forces people to start making changes. But when debt is cheaper, people can keep going deeper and deeper in debt. And we're already facing a debt mountain. So what could lower interest rates do? They can entice people to spend. However, the real question is, will people be able to continue affording spending more money? We're already seeing people trying to struggle in today's economy with the compounding high inflation, with the cost of spending as it is. So lower interest rates are there to stimulate spending, and that's what it generally does in the past. However, if people are already maxed out with spending, you might need a little bit more aggressive interest rate cuts to make it worthwhile for people to go out and spend money. However, in more sensitive areas like the housing market, you can bet that if mortgage rates fall significantly, you'd see more demand in the housing market, which could cause housing prices to shoot up even faster. And if that happens, well, that can make inflation even worse as well. So these are things you want to pay attention to. And this is where your goal should not be to try to time the market. Your goal should be an investor and to understand how the market works. That way you can put your money into the markets the best way possible. That way you own the assets that protect you from inflation, that benefit you when inflation happens. That way you can win whether the economy is up, down, or sideways. And this requires you to build your financial education. And again, we have a free ebook that you can download, and I got the link for you down in the description. The United States of America is facing one of the most unaffordable housing markets ever. But what if I told you that you can get paid to purchase a home? Take a look. President Biden and the White House want to give 500,000 Americans money to purchase a home. Now, to be fair, this headline by Newsweek and MSN is a little